Hello, everybody. Well, one of the most frequent questions we are asked these days is what is happening with the interest rates and why are they so high? So it's a great question because the rates have really affected the market this year, especially. So today I'm joined by Dave Ratti, the Ratti Lending Team at Envoy Mortgage. He's going to try to help us answer that question. So welcome, David.
Hi, thanks for having me.
Thanks for being here as always. So Dave, in layman's terms, as best as you can, what factors led to the increase in interest rates first and foremost? And then secondly, we as consumers, what are the key indicators that we can keep an eye on so we know what to expect as we move forward?
Well, those are great questions, and it's hard to answer with just a few words, but in general, mortgage rates have crept up the past 16 months or so due to inflation. The cost of living has increased. So these mortgage loans that were in the threes, not very many people want to invest in an instrument that gives them a return of 3% when their cost of living is going up 8%. So that's really the driver behind all of this. The good news is the Fed has taken a very proactive stance to keep inflation low, down to the 2% range. So hopefully we'll see some improvement next year, the year after.
Okay. So what are some of the things that you look at as a lender? I know there's a lot of economic data that goes into this, but what are some of the key indicators that we can look at as, general consumers to say, hey, this happened, so rates might tick down, or conversely, this happened, so rates might tick up?
Great question. There's so many, but there's a couple things just to keep in mind in general. First of all, ironic as it sounds, bad economic news is good for fixed mortgage rates, as crazy as that sounds. The second thing is, we keep using that word inflation, cost of living. Well, in economic reports, that's called CPI, Consumer Price Index. So that's something that people can keep an eye on. If the Consumer Price Index is high or going up, that's bad for mortgage rates.
So conversely, if that goes down, we might see a better pricing in the fixed market.
Perspective is important too, because we came out of a 100-year pandemic where we saw crazy subsidized mortgage rates, in the 2s and 3%, and that's really just not realistic in a normal economy. So I think we need a little bit of a reset there too. There are good indicators, and I guess you can answer this better than me. Do you think home prices are going to be higher in 2 years than they are today?
Who knows? It's that crystal ball thing, but I can tell you this, even though the market has been slower this year, pricing is not going down, right? So that lack of inventory is also fueling this fire, and I think it's going to take us a long time for the inventory to build up again. So that being said, it looks like we're not going to see home sales prices go down anytime soon. So to answer this and to kind of wrap it up, everybody, going back to the 2 and 3% interest rates, they're gone. We've been hovering, between 6 and 7% this year. So if you're looking to buy, jump in. The interest rates are not going to go back down to 2 and 3%. Home pricing is not going to, decline 20 or 30%. So, now is the time to buy. You can always refinance down the road if the rates go down, but just like we said, it's very unlikely that home prices will go down. So we hope the information helps. I know it's a lot of information that you're absorbing. If you have any specific questions regarding the market or interest rates, please feel free to reach out to David. His contact information is here on the screen. And of course, if you have any questions regarding real estate, talking about home prices, etc., I'm always here to help. My contact information is here as well. And as always, we appreciate you tuning in, and we look forward to seeing you the next time.